All right, welcome everyone back to episode number 24.
You thought you got rid of us.
Of the Wildlands podcast. We were off for a couple of weeks, school holidays, and lots of tips and recommendations coming your way at the end of this podcast.
Oh, look out.
I've got Matt Rigby here. We are recording this on the 22nd of July, 2022. There's been a lot happening, so let's get straight into Matt's Market Minute.
Which is probably 2 minutes today. All right, the Aussie market up 2.25 for the last week, down 10.7 year to date. A bit of an improvement from when we met last time. Just some stocks that kind of caught my eye over the last couple of weeks. Link, which we've talked about before, they're up about 13% this week. So the Canadian firm Dye & Durham has come back with a new offer at 4.8. That was originally 550. They pulled it. I think they offered like 420. It was rejected. Anyway, so Link have finally approved that. So that looks like that's going ahead.
It's like a Facebook marketplace negotiation. I'll give you $50, 40, give me 48, 43.
And then he turns up with like $20. Going,
yeah,
that's all I got. Megaport came out with some pretty decent numbers. They're up 25% for the week. And the numbers were strong, but I think market's expectations were so low and a bit of short covering there, I would imagine. Aluka coming out with a strong production report. They're up 20%. Linus, the rare earths producer, came out with lower production, even though prices were up. But interestingly, this kind of caught my eye and made me giggle a little. Their production was down because the company that they have a contract with to supply water just isn't supplying water. So literally they are producing and then there's no water, so they stop.
Right.
And then water comes through and they're producing again and then they stop. I don't know why. I tried to find out why he's not, or they are not supplying the water. I couldn't. But it struck me, Malaysia strikes me as somewhere where there would be plenty of water. I don't know, but anyway, maybe not. EML, the payments company, up about 9, almost 10% this week. They were talking to potential acquirers. That has been called off and the shares jumped on the back of that. If you recall, I think the last episode, we mentioned that the CEO had left and shares just tanked. Dusk, the candle company, I think that's what they do. They're up about 13.5%.
We were talking about candles yesterday.
We were.
The other day?
Yeah, that's right. Give me cookie dough scented candles any day of the week. So they're up about 13.5% on solid trading updates. So candles are in high demand during winter, you might say. ANZ with some big news, acquiring Suncorp's banking business. They're up about 1% this week. This was announced on Monday.
Do you think it'll get through?
Yeah, I don't know.
So two questions.
Surprised me.
Do you think it'll get through? Do you think it should go through? So should it?
Look at you
and would
with
it?
The questions. He's back. Look, I think. I don't know. I mean, it's a test for the new treasurer, whoever the hell that is these days. Labor government just in, bank trying to buy a smaller bank. I wouldn't be surprised if it didn't.
Didn't? Yeah, okay.
Yeah, I wouldn't be shocked. So ANZ are predominantly southern, Australia, Melbourne, Victoria, New South Wales. I don't think they have a big presence in Queensland, whereas Suncorp obviously do. The treasurer I read is from Queensland. Queenslanders are Queenslanders. They love Queensland. So I don't know how that will go. Just this whole big banks buying little banks. And Suncorp's not small. What are they paying? I'm sure I had it here. I don't. It's a fair amount, but they're doing a capital raise at $18.90 a share. They're currently trading at 21. Bendigo Bank and Judo have come out saying this is going to lower competition, which I think it will.
100%.
I absolutely think it does. Look, I'm going to take no, it doesn't go through. Do I think it should? No, I don't think it should.
I agree with you. I don't think it should. I think it does. It dampens competition.
And it's such a concentrated market. The Big Four just dominate.
The Big Four were praised during the GFC for our financial stability and the Big Four banking system here in Australia.
Which absolutely helped.
Agreed.
100%.
But then in the same breath, I think it was Kevin Rudd at the time, then comes out and says, well, now we've got to break up the big four. It's anti-competitive and customers, it's difficult to move banking and so forth. Yeah, I agree. I think somewhere in the middle between Australia and the US is probably the happy medium. Like, I don't think we need to have a different bank on every corner. Whereas compared to Australia, I think having 4 major banks, or maybe 5, if you. Macquarie's, is Macquarie bigger than ANZ now? I don't know.
No,
but
only because of their investment banking, not retail.
Yeah, well, they're getting pretty big
Bendigo,
in
according to
retail.
the ads, are the better little bank or
Well,
whatever.
a massive shout out to Macquarie. They're providing excellent customer service. The team there are awesome from a banking perspective. I don't know how you feel, but ANZ are absolutely shocking.
Shizen.
Absolutely
Terrible.
shocking.
Come on, man. What's
And
the
so-
CEO's name? Bloody
Shane Elliott.
Come on, man. What are you doing?
It's
just
yeah,
drives
it's
me
not,
nuts.
It's not Shane, but the reality is that ANZ's systems and services are just shit. I've personally had terrible experiences with ANZ. And if Suncorp, I don't know what
I thought the
Suncorp.
holiday would have mellowed you out, man. Jesus.
If Suncorp's, I don't know, I've got no experience with Suncorp banking, but I'd hate to see a leaf come out of the ANZ experience into Suncorp. But I think it'd be anti-competitive.
Yeah, I think it will too. There might be some pretty big concessions. They may have to. I don't even know how they get rid of parts of their business to make that work. I don't know. But yeah, look, I'll take the no. It doesn't go through.
Let's see where that lands. I'm with you on that one.
But I wouldn't be surprised either way. ANZ also came out and updated their interest rate expectations from the RBA, which I thought was really interesting. So they've come out now and said the RBA will lift rates to 3.35 by the end of this year. CBA updated theirs at 2.6. So quite a difference.
That's
there.
a big difference.
Where are we at 1.35? So
1.35?
CBA is expecting a little bit more than 1%, about 1.125. Whereas ANZ are expecting 2%
big jump
from here. Shit,
from
that's
here.
a lot. Yeah,
135, and so we get 50 in August. So we're at 185.
50 in September,
Yep. So 235.
and then what? Yeah,
Like, how is that even possible?
Another 250s
Unless they
and a 25.
Unless they jam 100 bips, like in
Canada.
November.
Canada did that
Do they
recently.
meet in December? Don't know.
I think do they have a month off?
Yeah, I don't know which
don't
month
know.
is the month off, but there's always the comparisons of the cup. The cup weekend, the RBA
yes.
meets. They do or they don't, you know.
Yeah.
And then there's
Punt on the RBA raising rates.
Yeah.
Anyway.
And then there's Christmas, like raising in December, raising or not raising before Christmas
Right
and
before
so
Christmas,
forth. So
yeah.
and we'll talk a little bit more about that as well. But that's a pretty big number for
That's
expectation
huge.
for the end of the year.
Huge, yeah.
I'd bet on there's no chance that's happening.
But I bet on recession following that at 3.35.
You maxed out.
We're done.
You maxed out.
Pendle up 17.5% on expectations that Perpetual will make a bid. Perpetual up about 6%. I think a bid may have been announced. And Zip.
It's Pendle XBT. Wasn't
Yes.
it?
Yep.
New logo, new name, all
That's
good.
it. Same deal. And Zip, for those that may or may not own Zip shares,
Thank you.
up 43.5%, mate. You're killing it.
Yep. What are they going from? 50 cents to 60 cents?
Well, 50 to 75. So they're back to where they were 6 weeks ago. Updating the market with pretty decent fourth quarter numbers.
Just let me know when they hit $11 again, yeah?
Get on board for the $11 train. And ending their pursuit of Sezzle. I think that's how you pronounce it. Anyway, that's a garbage company. Wouldn't own shares. And they realised it.
Sizzle?
NASDAQ up 6% over the last week, down 23.5 year to date. Interestingly, up 9.5% over the past month.
Yeah.
Have we turned, or is this a bear market rally?
Yeah, good question.
Just
I
really
no one's
interesting.
going to know until the benefit of hindsight, but yeah, we've been talking about that for quite a while, and
Maybe the past month, and we called the bottom. Is that what you're saying? No, it didn't happen. S&P
no bragging
500.
here.
S&P up 4.75 for the last week and down 16.6 for year to date. Again, up 6%.
Hey, was my
in the last
beginning
month.
year prediction down 5% for the year? Is that what?
I don't know if that was on here. That was something we talked to about
okay.
with a client. Yeah. That was off the air, shall we say. Year to date. So I don't have year to date numbers for NASDAQ, Refinitiv. I don't know what the hell.
Refinitiv. Come on, guys.
What's going on? Anyway, NASDAQ, S&P, sorry, positive. 96 companies, 19% are positive year to date. That was 107 last time we caught up. And I've changed the metrics here a little bit. So there are 209 companies down more than 20%. That's 42% down more than 20%. And just because we used to look at 10%, 311 down more than 10% year
10% is just like a daily correction now. You got to adjust your numbers to like.
Oh, it is for some companies. Holy cow. Disappoint earnings and you get walloped. Although not always, which brings us to the next bit. We're in earnings season again. It's just never ending. All right, so the following companies have beaten Wall Street's expectations. So Pepsi down 1.65% for the week. Taiwan Semiconductors up 2.5%. Citibank up almost 12%. State Street up 6.6%. United Health down about 1%. Novartis, the drug maker, up 1.6%. IBM down 10%. They said FX was going to hit earnings in the next quarter by about $3.5 billion US. That's why they're down so much, even though they beat. That's a lot of money. That's just the strength of the US. And the US and Euro have gone to parity. So that's a big factor there. Schwab, the online broker, 2.9% up. Goldman Sachs up about 14%. Halliburton, the oil services company, up about 0.75%. Probably a bit light on. I would have thought they'd beaten earnings by a bit more.
Just on IBM, they're I haven't got the March numbers, but December 2021 was 15.5 billion, and then you got a 3.5 billion hit on FX.
Yeah, it's a big
so
number.
as a percentage, it's a pretty big number, isn't it?
Yeah, that's why they're down 10%. And Tesla, up 13%. Came out with better than expected production given the Shanghai shutdown. And Elon commented they're having trouble, as everyone is, with costs and lithium prices and imports, but they're still making money. Made $2 billion, I think it was, for the quarter.
They've got Model Y in Australia's blown out. The costs have blown out. They've gone up since they released the car. The price has gone up, and now the weight is blown out to 1 year. So when the Y was released,
all right,
whenever it was released,
not long ago.
No, not long ago. The weight is
it was a couple of months.
November or December to February, so it's summer. In summertime, if you ordered it when they release, you'll get it in summer for the performance model.
Yep.
For the standard model, you get it in Q3, which is pretty cool. So you should be getting it in
soon.
Yeah, August
couple of months
to October, and then the performance comes after that.
Nice.
But if you order now, it's 1 year.
Wow. Okay. It'll be interesting to see the sales on the Y.
Well,
anecdotally, it's going to be popular.
It's going to be huge. I reckon you're going to be seeing them everywhere.
Yeah. I mean, you're seeing the threes everywhere. So
yeah, that's right.
Interesting. All right. The following companies missed. Delta Airlines, they were up 6% despite the miss. JP Morgan up about 5.5%. Morgan Stanley up 9%. BlackRock up 7.5%, the money manager. Boney, Bank of New York, up 5%. Wells Fargo up about 10%. Bank of America up around 10%. Lockheed Martin down 2%. That was interesting. I thought, given the war, they might be performing a little bit better. And Snap up 21%. Now, the reason I put that in there is there was a lot of question about how they were going to go given the advertising market. So there's been some commentary around advertising markets softening in the US. So I was interested to see what was going to happen there. But they came out with decent numbers, good expectations, and it wasn't as dire, I think, as what people were expecting.
Well, what'll be interesting, which I think we'll talk about later on, is the Microsoft Netflix. If you talk about advertising,
I
think that's going to be.
Yeah, no, absolutely. I think that's that ad-supported model. But anyway, we'll get into that later. And so emerging markets, what do we got here for emerging markets? We're down. Oh, actually, sorry. Netflix, just one thing. I'm going to steal your thunder. Netflix have come out with a bit more about their advertised supported model. They chose Microsoft. I know you're going to talk about this later. But what was interesting that They haven't come out and said this, but it's understood that Microsoft's pitch was, we're not Google, so we don't have YouTube. We're not Roku, we don't have our own kind of streaming service. We're not the Trade Desk, who was widely expected. Trade Desk were contracted by Disney. We are yours to do it ourselves. Our focus is on you. So that was interesting. They kind of went with an unproven Microsoft against some of the market leaders. So that will be fascinating to watch.
But I think the other thing there is Microsoft's marketing revenue is a lot bigger than what most people even think. I mean, I didn't even know that it was so big. I don't have the numbers here in front of me, but I'll get them up as we continue the conversation. Actually,
yep. And Amazon announced, I think overnight, that they're up 12%. Sorry, Netflix is up 28% the last week. Amazon up about 12.5%, buying One Life Healthcare, which is a subscription healthcare business. It's an all-cash deal, paying $18 at an 80% premium. Third largest acquisition by Amazon after Whole Foods and MGM. That was just something that kind of caught my eye. And VG, emerging markets, down about 0.3, 0.4 for the week, down 14% year to date. Oil down 1.3 for the week, up 28% year to date, and currently trading at about $96 a barrel.
And petrol prices are coming down.
They are, finally.
Diesel prices are coming down, which is good to see.
I think I saw petrol at 192 this morning as I was coming in, which was refreshing, to say the least.
Hopefully electricity prices also come down by the time everyone's Y model has arrived and they're plugging the wall. Yes. But maybe get your solar panels in and just...
before summer.
Hey?
Before summer, before the sun comes out.
Yeah, that's right. And you've have a nice big battery and you're good to go.
Yeah. And Bitcoin finally up 9% for the week, year to date, sitting at about 51% down, $23,128 a coin.
You didn't buy it at 17,000?
No, I'm waiting for the fall.
But okay.
So the year to date low is, I'm just looking at it now, I think US dollars again, 18,948. The year to date high is 47,454. That's a big range.
Big range. It's a risky asset. And
price of entry.
Not a bad price of entry right now, especially given all the other coins that are absolutely collapsing. Bitcoin continues to remain relatively...
Yeah, so I haven't kept an eye on the others.
Stable.
What are they?
Yeah, are they doing worse? They're all falling off the perch.
Yeah.
Let's jump into the consumer conundrum. It's the first topic that I want to talk about. Inflation continues to persist. We previously discussed, you and I, inflation peaking with an expectation that July, August will start to see some rollover and some lower numbers. Last week CPI came in, and I'll just bring this first chart up. I've got a ton of charts here. I'm going to just go through them really quickly. This is CPI, and it is the biggest jump at 9.1% year on year since 1981. Pretty big, right?
Yep, huge.
The second chart I want to bring up, though, excluding food and energy, which tends to be a lot more volatile in the short term, core CPI was up, I'll bring this chart up, 5.9%. Now, the interesting thing that I took out of this is that it's below the March peak of 6.4. Now, I don't know if you can see on the far right-hand side of that chart, though, so core CPI, it seems to have turned the corner.
Yeah.
It seems to have peaked. It's coming down. It will be interesting to see if we start to see core CPI come down again in the next month and the following, etc.
Yep.
But I'd probably take a bet that I reckon we've turned the corner on that one. But I've been proven wrong many times in the past. Michael McDonough, chief economist at Bloomberg, had this chart which I thought was pretty cool. It's summarized with the green being energy, the green bars being energy, orange being food, and then we've got services, X food and energy, goods, X food and energy in red. And you can see headline CPI still climbing, and that's taking into account predominantly energy and food prices. And then you've got core year on year, as we've discussed, and you can see that start to come down. But the interesting thing here is that services, I mean, price of goods appear to be coming down.
Yep.
You and I have talked about that in the past, about the risk that, or the potential that prices for goods could be coming down, which could be deflationary. And it seems like is, well, according to this anyway, as to what is playing out. But services continues to go up. Why do you think services continue, the price of services continue to go up?
My initial thought is that it's difficult to get people.
Do you reckon it's the people that's the biggest part?
I do, and as I said before,
wages?
That services inflation is really, really sticky. I mean, if you hire someone at, I don't know, $15 an hour, and you were paying the last guy 13, the next person you're not dropping back down to 13. Even if inflation comes down, it's really difficult to get that.
But
down.
the guy or girl that you're paying $15 for,
yes.
you're not going to give them a pay cut, and then
no, exactly
once inflation comes down,
hey, inflation's down, I'm going to drop. No, well, I wasn't thinking of that. The last hire, I'm thinking the next hire. So once you set that, I presume, once you set that income benchmark at say 15 an hour, I'm just making that number
I disagree.
Up, you reckon the next person you could hire at 13 an hour if inflation has come down?
Yeah, because you've got a higher unemployment rate.
Yeah,
and more people are willing to take a job. The only thing I reckon
you'd want a substantially higher unemployment rate.
Yeah,
but
whatever it needs to be. But I reckon the people that are on I don't think you can give someone the pay cut.
No.
I think what you need to wait for is for sort of the market to rise back up to that level.
Yes, so they may not get a pay rise for a couple of years.
For a long time.
The market will meet where they're at. But
that's right.
Yeah,
So I thought this was a really interesting chart from Bloomberg. So I'm showing these charts because it has a massive impact on sentiment, and sentiment is just in the absolute dumps at the moment, and it is literally in a garbage bin that's on fire right now. This chart from the University of Michigan is the current financial situation compared to a year ago, and if you have a look at the sentiment now sitting at 71, I think at the index level, this is well and truly below the COVID levels. We are getting pretty close to.
I thought that was COVID, but no, you're right.
No, that's not COVID.
God.
we're getting close to peak GFC levels.
Yeah.
So at a point at that time when sentiment bottomed out, that's Lehman Brothers collapsing. That's the financial system's going to end. Like that's how people are feeling. Right now.
Yep.
Now that's people. The other one I want to bring up is businesses. I've got this chart here, and I don't even know who published this chart. The National Federation of Independent Businesses. So they're reporting, quote from the report, 34% of owners reported that inflation was their single most important problem in operating their business, an increase of 6 points from May, and the highest level since 1980 Q4. That just looks like a fat finger error, don't you reckon?
Absolutely, 34%. I would have thought that number would be higher.
You reckon?
Yeah. Look at that chart. Holy cow!
But I mean, if you have a look at it, percentage of firms has never been an issue. Like literally.
Yeah, that's. I mean,
the biggest issue has been insurance in the early 2000s. I don't know what happened then.
08, 09.
But we haven't seen anything.
Yeah.
Like that. I mean, you talk about the biggest thing here is if we have a look
is that post September 11 for
regulation,
the
possibly. So inflation's on everyone's minds at the moment. Couple of things that I read in Bloomberg again, which I'll bring these up, which are shipping and container costs. So I'm going to quote from Bloomberg: "Getting back to normal, shipping costs, which had surged amid virus-fueled bottlenecks and a shortage of containers, are slowly steaming back down towards pre-pandemic levels. The Drewry, Hong Kong, Los Angeles benchmark for 40-foot containers rates dropped almost 6% in the week ended July 20 and was down 21% from the same period last year. Port congestion in Southern California lessened and rates should continue to moderate," Bloomberg Intelligence wrote. But you can see those charts there, the 40-foot containers, nowhere near pre-pandemic levels, but certainly dropping pretty quickly.
Yeah.
The one that's dropping, if you have a look, is the year-on-year change. Huge.
Yeah, and that's getting back to the pre-pandemic lows.
Yeah, so costs are coming down.
And that's dollars, right? That's
So
not
the
percentage.
top one's dollars. The bottom one is the index.
Yeah, okay.
Is an index level.
Yep.
And so the year-on-year change, it's huge. It's massive. And so I think part of some of that is going to impact inflation as we continue to progress throughout the year. Now, having said all of that, everyone's concerned about inflation. This is the issue that I'm really struggling with, and why I would continue to believe the consumer rather than believing these surveys, is that consumers are continuing to spend in all categories: furniture, restaurants, bars, cafes, restaurants. And in fact, I'll bring this chart up. This is total retail and food sales, a record $680.6 billion just in the last month.
Oh, that's a month.
That's the last month.
Jeez. Yeah, it is too. Okay. Big number. You know, it was funny. I'll get into it in a minute bit, but I wonder whether people are just go out and spend, worry about it later.
We'll talk about it in a second. A couple of other things I want to just finish up on. Earlier this month, US employers added a whopping 372,000 jobs in June
Which is
alone.
much higher than expected.
Huge, right?
Yeah.
And so we got people that are hiring. The job unemployment rate is low. I mean, that could be turning with what Microsoft are doing, some of the tech companies as well.
Yep.
You've got retail sales up. You've got really strong economic data versus, so you can look at the facts or you can look at the headlines. And I mean, I know what it is that I'm looking at. Look, the bottom line for me reading all of this is that I think inflation's going to be sticking around for a lot longer than a lot of people had thought. I feel like right now, the good news in the economy is the bad news. If someone told you that unemployment rate's really low, consumers are spending, yet they're telling you something else, but what their credit card is doing is something that's very, very different. And interest rates are going up because you've got a heating economy or a warming up economy or a hot economy, whatever you want to call it. Like, I think that's a good thing. I don't think we're in recession. I'm just trying to remember where these numbers came from, but changes in interest rates operate on an immense lag of 6 to 12 months. And so we've discussed this before. Recessions happen at the peak of a rate hike cycle, not at the beginning of a rate hike cycle.
Yep.
So that's kind of my dump at the moment. There's lots going on with inflation, but a whole bunch of other things going on with what consumers are doing. Now, what was your question?
I don't know. No idea. But something I will mention is, and something I didn't
What do
realize.
you think about that?
Well, just a million different things. So the US Q1 GDP was negative. There's a survey I think it's like the Richmond Fed. I don't know. Someone comes out with one of the feds comes out with like
an early one.
Kind of an early headline.
Sure.
We've surveyed a couple businesses, people, whatever. And that's looking negative for Q2 as well. Which, to your point about the spending, those two things just don't marry up in my mind. But then I was reading that the official definition of a recession is defined by this very secretive group that meet every so often. They don't tell, no one knows who's in this group.
Who are they?
I don't know. No one knows when and where they meet. And then they come out with this statement to say, we've looked at all the data and this is when the recession started. Crazy. But anyway, so I don't know. I'll have to find the details, because I remember reading it in Bloomberg, just laughing, going, do these people actually exist or did someone make this up? But it's definitely conflicting. I think sentiment leads reality. I think we looked at a chart a little while ago with sentiment kind of off the chart and spending going up, and they're going in different directions, which hasn't happened all that often. And we were trying to work out, we were kind of discussing which one leads what, concluding that it will probably meet somewhere in the middle. But I think, I was chatting with a mate last night who's in Europe, and I'll mention more about this later, but he was saying that people over there are everyone's on holidays. Like, everyone is out, they're all going whatever, interest rates are starting to go up, inflation's off the charts, and everyone's like, doesn't matter, we'll deal with it.
Oh, that's what you're asking?
Yeah.
Doesn't matter?
Doesn't matter, yeah. So he was saying that he thinks, and he's in retail, he thinks that it looks like people are burning through their cash savings and we'll probably end up back to where we were, and that is we're at a little bit of a buffer, things are tight, and everything slows down. That was kind of his take on it. Which,
But what's the runway? That's the question, right?
yeah,
like
well,
how long
no,
does that
exactly.
go on?
Well,
for?
the ECB raised last night, so that's an interesting. Over there, they have 30-year fixed rates in Europe, or certainly France.
Oh, I didn't know
continental
that.
Europe. No, I didn't know that either. And Canada have 30-year fixed rates, but they reset every 5 years. We were chatting to a client earlier this week telling that. So every market's different. Everyone feels pain at different points in time. Yeah, I don't know. I still putting money on a recession in the next 12 months.
Well, of course there's going to be a recession. You can't not have a
Genius,
recession.
right?
Far out. I mean, the other one was owning. So investors pessimistic on stocks, yet their ownership of stocks have never been this high.
Yeah, and they haven't fallen. I mean, they've trickled off a little bit, but nothing like what you would see.
No.
The other thing, I was at a briefing the other day with T. Rowe Price and the lead manager, I can't remember his name, but he was saying that he was at a conference with Jamie Dimon and a few others, and they were all like, the Fed is going to run this bus off the cliff, and they don't give a damn about recession. It's all about inflation, which makes sense. And, he was saying Jamie Dimon was on board with that because the short-term pain of a recession is nothing like the long-term consequences of sustained inflation.
Sure.
So I think, it's a foregone conclusion. It's just a matter of when.
Let's jump onto your topic.
We'll look at that shortly. All right. So I've got some inflation stuff here as well, kind of on the back of what you just said. We'll bring this chart up now. This is the monthly change in inflation. So this is month on month before you had the kind of annualized. Mm-hmm. The reason I wanted to bring this up is because of the point you mentioned. We had talked about inflation this time last year was quite high on a month on month and persistently high. But however, looking at this, we're April 2021, it was sitting at, I'm going to call it 0.65, I don't know. But it's dwarfed by what we've been seeing. 3 of the last 4 months are significantly higher than that. Now, this is headline. So what we've seen is commodity, energy has come down. Commodity prices generally have come down. They're a pretty significant input into inflation. It takes a little while for it to feed through, but I still think by the time we hit September, October, we're going to start to see a decent decline in that annualized inflation rate. And further to that, I've got the core number, which you kind of referenced. So the core number in the US peaked at 6.5 back in March and has slowly trickled down since then. This, I didn't realize this. I kind of came across this chart by accident from Trading Economics. This is getting no news at all that I can see. Everyone's talking about the headline number. So that core number is important. The Fed focus more on that.
That's right.
Than they do the headline number. And then thought I'd throw European core just as a bit of a comparison. And so the European core, it's lower, but it started from a much lower base. And the ECB are only just starting to raise rates, and they've gone up 0.5% to zero. Like they got a long way to go. So this mate I was chatting to last night, he was saying that the cost to power their manufacturing sites is about 4 million euros a year. They just got their energy expectation or whatever for the next 12 months, and that's going up to 12 million. So there's a whole lot more. There's a whole lot more inflation coming down the pike in Europe. Like they're only just at the start of it.
Yeah. Do you think different parts of the world or economies can isolate themselves with what's going on? It's bizarre because with all of the war tensions and everything that's going on in Ukraine and Russia, it's like right there.
Yeah.
Right. And they're the closest to it all. And it's just bizarre how far behind some of these countries are relative to that of the US and certainly us as well. Yeah, and it kind of, when he was telling me that, I was just dumbfounded that price hasn't come through first. And I don't know if they're annualized kind of fixed rate. So, 12 months ago they set that one. That's probably the case. But if you multiply that across Europe, and you're right, they're right at the doorstep. They have fewer options than anyone else. And, he was saying that the government there are recommending or asking people to limit the temperature of their thermostat. So in winter, you can't
or you shouldn't have your thermostat set above X degrees.
What do they have? People knocking on your door, checking your heater?
I mean, it wouldn't surprise me, right? So yeah, they're about to leave and come back to Australia, so we was pretty happy on the timing of that. But yeah, pretty interesting. That really surprised me about the energy costs. So potentially there's more coming through. And one other thing, so getting back to the US, we've been talking about housing and how that market has held up pretty well. So we'll bring up this chart here. This is out of Bloomberg. So looking at the sales slump. So US existing home sales declined in June on sinking affordability. So sales of previously owned US homes fell in June to a 2-year low as the surge in borrowing cost continues to erode affordability. Not a surprise given what's happening to rates and certainly where they're expected to go. Contract closings fell 5.4% from May to an annualised 5.12 million figures from the National Association of Realtors. The meeting estimate was about 5.35.
I thought that was retailers, and I thought, why the hell the National Association of Retailers?
Realtors, yeah, not real estate agents. Anyway, so it was below the median expectation, and I think I read that it's one of the lowest since. Oh yeah, that's it. It's
So what does that mean? US existing home sales,
so not new home.
But is it the number of homes, the value of homes?
Number of homes,
right? And how do they measure that it's existing sales? How does that work?
Well, I guess it comes back to
it's like
when was the
turnover?
home established? Yeah. So it's a number of existing established homes that have transacted over the last.
And so we're just seeing less transactions.
Seeing fewer transactions.
So how does that? Right. Okay.
Yeah.
Gotcha.
So we're seeing that, but interestingly, I've written here somewhere. It's not all bad news. The median selling price rose 13.4% from a year ago to a fresh record of 416,000, and first home buyers accounted for 30% of US home sales, up from 20% in May. So really interesting. Such mixed. It's not unlike the sales and consumer confidence. So again, I wonder whether this is just the start of it. If people are kind of going, all right, now's our chance to get into the market. Great, let's do it. Who knows what's going to happen? But being new home buyers, but more established or families that have bought before are less and less inclined to be buying. But
it could also be that people have bought and they're not making any changes given the uncertainty with what's going on.
Yep.
And in terms of median, for whatever product is on the market at that point in time, for people who need to buy a home are now limited with options and number of properties and supply, which could possibly push the price up.
It could, and maybe it pushes the price up in that mid-tier market. Not the high end, not the low end. But yeah, I couldn't afford that $800,000 house, but I can a $600,000. I'm just going to do it.
And I'm going to pay $650 for that $600,000 house.
Yeah, something like that.
It's such mixed data, isn't it?
Yeah, it really is. The other thing that home builder sentiment has also tumbled. So both groundbreaking and building permits for single-family homes dropped in June to 2-year lows. And mortgage applications are the lowest since early 2000. So it's definitely, the housing market is 100% cooling over there. We're at this, I kind of think about it like we're at this turning point where the data's a bit mixed. Some of it's still going up, some of it's still going down, but eventually it's all going to start to sink and go down, is my thought on that.
Could it go the other way?
It could. It's not
just
going
given
to,
how noisy all the data, given how noisy all the data is and how mixed.
Yeah, but I think if you overlay the Fed's going to raise by another 75.
All right, let's talk about that. Let's keep going.
So on interest rates, which is a nice segue, the yield curve. So we've talked about this so many times. The yield curve has inverted. It's been inverted for a couple of weeks. So for those that haven't listened to our previous 23 podcast, the yield curve inversion is generally, not always, but generally a bit of a lead indicator to a recession. And typically it's some 6 to 9 months out from the start of a recession. So we've inverted by about 0.13. It doesn't typically invert by a lot. It has in the past, obviously in 1980, but more recently, since 1990, it's inverted by maybe 0.5%, maybe 3/4 there in 2009-ish. But certainly it's infrequent, but when it happens, it's quite notable. And often, so there's the 2-year, 10-year spread, There's also the 5-year, 10-year spread, which is less likely to invert because it's a closer period. That's also inverted. So, we've got some kind of flashing signs there, if you like, and not surprisingly, that short-term rates are going up. Long-term rates are starting to fall, and they're at about 3%, I think, 10-year, which they were under 2.9, 2.95 at one point. They've been as high as 3.35. The one thing I would note is the yield curve, as the Fed raises by 75 basis points the last two increases, the yield curve hasn't really responded to that. The market's sort of taken it in its stride, which for me, I take that as the market's gaining more confidence that the Fed's getting on top of this inflation issue, that the market's now taking the Fed seriously, or the market's saying the Fed's taking it seriously, and there's less concern that inflation is going to be persistently out of control, which leads me to the stock market view. My comment earlier, is this the bottom? Is the market looking past the next 6 months going, all right, here's the recession. We can see where the end of this high inflation period is or we think it's going to end soon. Are we seeing rate cuts starting to be built into stock prices, and companies coming up with pretty decent earnings as well? So it's just a mixed bag at the moment, but things feel a bit more stable than what they did say 2 months ago.
Oh, I'm glad to.
What do you think?
You feel that way?
Yeah, feeling great. No, I think as soon as we start to see that headline inflation really start to come off and core come down a bit more, I think the market will start pricing in a pause or cuts from the Fed.
I mean,
if I look at that stock prices,
if I look at that chart that you had up there before, I don't think so. The recession that we had in 2020, so the yield curve inverted in 2019.
Yep.
Right. And then we had COVID.
Pre-pandemic.
Yeah, pre-pandemic. So the question is, are we just going back to what kind of should have just played out back then?
Yeah, that's a good question.
If you kind of just eliminate the COVID
and the stimulus
timeframe,
and all that.
Yeah, because it had already inverted. Now, I don't think you can say we had a recession because the yield curve inverted in 2020. I don't think you can say that.
No. But were we on track to have one anyway? I think
that's what I'm saying.
That's the question that we'll never know the answer to.
We'll never know the answer to. But I guess the point that I'm trying to make is that if we didn't have COVID, if we didn't have the pandemic, my gut says that, and based on this, is that we probably would have had a recession.
Quite possibly, yeah.
And so I feel like we're just going back to kind of what should have unfolded from following 2019.
Yeah, and look, I'm just looking at the container cost chart that you had up earlier. If you take container cost as an indicator of seaborne demand, and therefore, retail sales, et cetera, I mean, it was falling from early 19 into late 19. So maybe retail sales were starting to fall off at that point. So, maybe we were headed for a recession, and COVID in a weird way maybe saved us from that. And we had it was pretty brief, but there's a hell of a lot of stimulus coming. That wouldn't have happened in a normal recession. Yeah,
you're right. Rate per 40-foot box is dropping. Year-on-year change was dropping significantly. We bottomed out in just before the end of 2019, and then started skyrocketing through through COVID. Yeah, that's right.
Yeah,
and we're kind of going back to that.
We're going back to that. So I wonder, I do wonder whether we are heading back to, if you wipe out 19 through to 23, just wipe that period out, are we just going to be back to where we were at 19? Well, interesting.
Let's find out we'll
find out in about 18 months.
12 or 18 months' time.
What do you got, mate?
So this whole topic of rate hikes, I've been reading a number of different analysis and reports that are coming out about what the impact is going to be on the housing market with rates rising. So, what's the deputy governor's name again?
It's a female.
Yeah, Michelle.
Yeah.
Michelle Bullock. So Michelle spoke, where did she speak? In Brisbane, only a few days ago, about how households are placed for interest rate increases. So I was reading the speech, and I found it really interesting. I mean, one could say, well, ignore what the RBA has to say and ignore their charts and their analysis. But I think these are just facts. So rates are rising and everyone's concerned about the impact it's going to have on borrowers. So there's a few things that I've been thinking about and looking at, and certainly came out in Michelle's speech. So I'll bring this first chart up now, which shows the repayment increases for variable rate loans in response to 200 basis point increase in interest rates.
Okay.
So what this is saying is that on the far left-hand side of the chart, about 42% of borrowers, it's going to have no impact. And I'll explain to you in a second why.
Okay.
And then you can see the second column there from the left-hand side, which is 0 to 10, and you've got 10 to 20, 20, 30, 30, 40, 40 plus. That represents the percentage change of average repayments on loans.
Yep.
The vertical bars on the left-hand side and right-hand side represent the percentage of borrowers. So let's say it's 8 or 9% of borrowers are gonna find themselves with repayments that are 0 to 10% higher than previous. On the far right-hand side, what that's saying is that 40% of borrowers, 20% of borrowers are going to feel see a change of 40% plus on their repayments if rates rise by 200 basis points. And I read the speech and the RBA's analysis and others that have come out subsequently. It's not, and you and I were chatting about this, like from now, from 6 months ago, 200 basis points. It's 200 points in 2023. That's the widely expected
by 2023.
That's right. So it's effectively, think about it as the end rate. Where's it going to land? At 2%. This is what the RBA analysis suggests. So that particular chart was done a month or so earlier than this one. So this is the updated one. This is at 300 basis points. This is what Chris Joy's talking about. This is what the Kook's talking about. This is what all the economists are talking about why it's problematic. So if rates go to 300 basis points or 3% in 2023...
Basically where ANZ think they'll be.
ANZ think they'll be at 335. Was that not? CBA was 285.
So 300 on top of where it was.
No, not on top of. Well, on top of where it's 0. We're at 0.1.
Oh, yeah, we were too.
So just think about it as 3% in 2023.
Yep.
We're looking at about 35% of borrowers are going to feel no change.
Okay.
Just under 30% of borrowers, up from 20%, you jumped another 50% of borrowers are going to feel the pain of 40% plus change on repayments. And so the reason why you've got such a big number on the left-hand side is because over the 2 years, as rates were falling, people kept their repayment levels at the original repayment level. So people don't generally decrease as rates fall, they don't generally decrease their repayments. And so, I might have some of these numbers. We'll have a look in a second, but they're so ahead. I think they're 2 years ahead. The average loan is 2 years ahead on their repayments.
Yeah, I've heard something like that.
There's a pretty big buffer there, and that's why you've got such a big number on the left-hand side. They're not going to feel anything. Mm-hmm. But the conundrum is on
the other end.
And
they're going to feel it hard.
Almost not quite equal, but a very similar number. So it's almost split 50-50. And then you've got the middle. No change all the way to, we're going to see a 40 to, and some borrowers are going to feel a 60% rise on their repayments. So what about fixed rate loans expiring? And I'll bring this chart up in a moment, but quote, the extremely low interest rates on these products through 2020 and 2021 led many people to take them up, resulting in the share of housing credit on fixed mortgage rates increasing from 20% from 2020 to a peak of 40%. And so people fixed rates. So the fixed rates went from 20% to 40%. Mm-hmm. Remember, you could fix your rate in at 1.83, 1.95%, your home loan, right? For like 2 years, 3 years.
Yep.
And so borrowers fixed rates in. The majority of currently outstanding fixed rates loans are due to roll off within the next 2 years. And I'll bring this chart up now. On the left-hand side, you can see the percentage change. On the right-hand side, you can start to see hold on. No, that's not the chart that I wanted to bring up. Let me get that one off for a second. But let me describe it for you. Essentially, during the second half of 2023, you've got most of these loans that were locked in, because most of them are 2 years, in 2021, that are coming off to mature. And so 40% of these borrowers are not going to feel anything until the end of 2023.
Yep.
And the rest of them have 2 years of a buffer. And remember, banks assess on assessment rate, not the actual rate.
Yep.
And so I feel like there's quite a bit of insulation that borrowers have between now and 2023. And the thing that I'm thinking about is that, yes, although it is problematic, the other thing what we don't know is how much savings these fixed loan borrowers have, because you can't see how much buffer they have. And so... And not anecdotally, the data tells us people have got savings rate, like you were mentioning before, and that's almost at records. People are adding to that. They've got that to work with. Offset accounts, the RBA can't see to match that off on loans either. And plus, not everybody fixes all of their loans into fixed. So most people do like a 50-50 split.
Yeah.
And so if you've got that loan, generally most people will be ahead on the variable side as well. So my take on this is, and I'm curious to know what you think, my take on this is that we're going to have the next 2 years whereby you've got quite a bit of padding and fat and insulation that borrowers have in the forms that I've just discussed. And by then, I wonder if rates have peaked and maybe we're in a recession or have had a recession, and rates are now starting to come off. As these loans are maturing at the end of 2023, your rates are going from 3% to 2.75 to 2.55, and rates are getting cut.
So your fixed rate will probably go from, let's say, 2%
to 3%.
Up to 3%, and then trickle back down.
Potentially. Or in fact, if you wanted to refix then again, 2 or 3 year fixed rates might be even lower, taking into account a declining interest rate environment.
Yeah,
so
possibly.
That's kind of what I've been reading and looking at and thinking about. What do you reckon about all that?
Yeah, look, it's fascinating because, I don't know. I mean, even if you've got a fixed rate loan, you're seeing your variable side of it go up. You're seeing inflation. You're seeing, supermarket shopping costs go up. You're seeing petrol go up. I think even if you've got a fixed rate loan, people still start to pull back on spending to build that buffer, because...
Do you think people are that forward looking?
I think they are, because, I mean, just anecdotally speaking with friends who are in not too dissimilar situations. I know friends who've got fixed rates and they're seeing the cost of everything just skyrocket, and people are pulling back. And even though their loan's not fully variable, they're still kind of pulling back.
Well, that's not what the data says. Retail sales, travel... Qantas, I mentioned a couple of weeks ago, they doubled their business class flights. They booked out. Alan Joyce came out. Saying that the next 2 to 3 weeks, which is primarily school holidays, you couldn't get a flight on a Qantas flight.
No.
He said they were 90% booked on all flights.
So what will be interesting is September.
Why?
Well, because by the time people had booked those flights... or before, so people have booked those flights and those holidays, and then, I don't know, I'm guessing the RBA really started to ramp up rates. So that is now built into expectations. If you're thinking about the September holidays and you haven't booked somewhere now, are you booking it, or are you holding off? Are you waiting for, I just wonder, again, interest rates take a while to have an impact.
If you haven't booked it now, you're going to pay top dollar. That's the bottom line.
Is that what it is?
Yeah, we booked Bali for September, October.
Okay.
And it's school holidays again. And
so you pay more anyway.
You have to pay more, but the flights are booked. They're all booked out.
Oh, really? Okay.
Yeah, all booked out. And the other thing is, and we were chatting to someone about this, and they also raised this point, is if fuel is so expensive,
yes,
why are people filling up their cars? If fuel is so expensive to fly around and whatnot, why are people still paying airfares to travel?
Yeah.
If food is so expensive, why are retail sales cracking records? It doesn't make sense.
No.
When people are telling you about how they feel about things versus what is actually going on,
But could you feel one way and still be spending another? I mean, clearly people are, but do they really feel that? I guess is your question. And my thought is maybe you are really feeling it, but you just, you've got a buffer there. You're just going to spend it anyway.
Maybe.
We'll find out in time, but it's pretty interesting to look at it, to think about it. Human psychology, good luck trying to work that out. But I don't know. I don't know what to make of it all. People are spending and not concerned. Maybe they're comfortable because unemployment rates are so low, which again is at odds with consumer confidence and expectations.
My feeling is that this whole recession thing is just being driven by
the media.
There's a cynic in me, but media.
Gee.
Who'd have thought?
Yeah.
But I feel like it's just the narrative and just the thing to talk about.
Are we going to talk ourselves into it? Recession?
Well, if you say we're gonna have a recession. I don't understand why people keep trying to avoid the fact. Like, we're gonna have a recession. It's just
When?
Economic fact, right? When, how long, all of these things. If you're in 2020, not that long ago, people, it was absolute Armageddon. Literally, it was Armageddon. The world was going to end. People were falling and like flies in the middle of the street because they got COVID and they fell and they just died. One of the shortest recessions on record. Go figure.
Mm-hmm. To what your point?
Well, I don't know what my point is. My point is that we're going to
I was just wondering if I'd missed something there.
My point is we're going to have a recession. Just because we have a recession, it doesn't mean that it's going to be this long, prolonged thing. And by the time we know that we're having a recession, markets have already turned. We know this every single time.
And we're closer to the end than the start by the time we realise we're in it
100%.
most of the time. Yeah.
100%. So, look, time will tell. Bring on the recession. I feel like just have it and freaking just get it out of the way.
Yeah. And I think that's what, that's what Jamie Dimon was basically saying. Let's just get over and done with and get back to normal.
But recessions are also normal. They're running out of time, so let's...
Right. I'll just really quickly... just something else that kind of caught my eye that has been getting a bit of headline, and I was reading this about the Chinese home buyers. So for those that don't know, in China, a bunch of developments have paused or stopped. Evergrande.
Are you talking about Queensland or are you talking about China?
China.
Okay.
Did I not say China?
No, you did, but it's happening in Queensland as well.
Okay.
The media is reporting all these property... We were in the car the other day and Deb goes to me, what's going on in the property market? All these property developers are collapsing. I've read like another property developer collapsed. And I said, who was it? She said, I don't know. They owe like $2 million. I'm like, $2 million, a property about $2 million. It's like, that's probably some guy and his wife, or his wife and her husband, or two guys or two girls or whatever they are.
A couple.
Thank you, Matthew. They're just doing some townhouse developments. Like, these aren't nothing, right? Property developers collapsing. Like, this is what's being reported in news.com and all these outlets that, and I read one, Queensland property developer collapses, and I read it, and it went on to say that the developer had loans outstanding of like 640 grand. I'm like,
man, that's
what?
People have more than that outstanding to buy a home, like even an apartment.
So anyway, that was a joke. Queensland and China.
Missed that.
Yeah,
joke.
No worries.
Anyway, back to where we were talking. So in China, just to be clear. So Evergrande, we heard about that.
Yeah.
When was that? Earlier this year? Late last year? I don't even know now. So big developer, ran out of money, basically, stopped developing. And so similar sorts of things are happening across China. And so across 22 cities, a whole bunch of people who had bought these off the plan apartments have just basically decided we're not going to pay the mortgage anymore because you're not going to deliver your product, so we're just not going to pay. Which has caused a bit of a stir, as you could imagine, in China, where there's not a lot of reported civil unrest and whatever.
So it's causing civil issues.
It's causing some civil issues, yeah. And they were talking about, there's a whole bunch of issues wrapped up in this. But essentially, so the article goes on to say, middle-class Chinese are boycotting mortgage payments across at least 301 projects in about 91 cities.
301 projects out of 5,000.
So billion. How many houses in each or units in each of those projects? Who knows?
Probably like one project.
It's not. Anyway. It's a few more. Anyway, across 91 cities, so it's fairly widespread. So property makes up about a fifth of China's economic activity, and some 70% of household wealth in China is tied up in real estate.
Yeah, no different to Australia.
So not too dissimilar. So they're talking about, China and they're coming up to their 5-yearly hoo-ha conference thing, whatever the hell it is that they do. Anyway, the 20th Party Congress. And how this is kind of coming at a really bad time for him. He's got issues with COVID and locking people down, and people now getting a bit sick of that, understandably, and they're going back in and out of lockdown. They've got this and that happening. But what kind of caught my eye is the boycotts only affect a small portion of combined mortgage portfolios, which isn't overly surprising, I guess, when you think about it. So they've got a chart in a graphic in one of these links here, showing the number of cities across, and I'll bring this up now. I don't actually have it in the doc. There it is. So the mortgage revolt. So they're kind of graphically shown where each of these cities are, where it's kind of happening. A little bit on the edge of Beijing, but most of them look to be in the kind of the mid-tier cities, so not the major cities. So kind of what would you call that? The East Coast or Southeast area tends to be where most of it's happening. So the point of bringing this up is, to me, it feels like, to your cynical point, it feels like it's a bit of a media beat up. It's a bit of a, Xi is doing this, he's doing that, he's in trouble. This kind of media is trying to create the narrative, which doesn't seem to be happening. The total volume or value of mortgages affected is about 297 billion, which in isolation sounds like a big number. I couldn't find out the total number of Chinese mortgages or mortgage value of mortgages in China, which I suspect is significantly more than 297 billion. But the other thing is that they're talking about maybe, and the government's talking about maybe giving a mortgage holiday to people impacted by these projects, delays and cancellations. And it was commented that, this could actually be worse, because so people who aren't included in that mortgage holiday might start to go, well, hang on.
What about me?
Things haven't worked out as well for me. Our prices are down. I'm going to stop paying my mortgage as well. So that moral hazard. And we've seen this all over the world, where you start to make things easier for one group and another group of people start to go, well, why don't I get that? So I just thought it was pretty interesting that the media's kind of been, and Bloomberg is where most of this is being reported that I'm reading.
$5.6 trillion US dollars.
Yeah, right. Okay. So
what was your number?
Let's call it 300 billion.
Yeah, so 5.6 trillion.
What's that, 5%? Less than? Just over 5%?
Yeah, so I was just doing the currency conversion. There's 38 trillion yuan of outstanding residential mortgages.
Okay. And the other thing was that selling prices for properties in these projects or nearby projects, more likely nearby, are down about 15% on average on the purchase cost over the last year. So about a 15% fall in that property development off the plan property market.
Yeah, I feel like China, it sounds to me like a bit of a scraping the bottom of the barrel for some sort of news here.
Yeah, I mean...
Well, do you remember when China was...
Property is a big driver in China.
Yeah, and Australia. People talk about the amount of debt that is associated with Australian properties and mortgages, but no one looks at the other side with the assets.
No one. Most people don't. Some people post stuff on LinkedIn that says, look at the other side of the ledger, assets, liabilities, right?
Do you remember when China was building roads to nowhere? Do you remember that?
Yeah, the ghost cities.
Ghost cities, yeah.
That was a huge thing. Ghost cities, no people.
And look at this.
Well, they're probably all fully populated now.
100%. I would rather have roads to nowhere and then fill them in, rather than what our government does, which is no roads to nowhere.
You have to walk to the road, push your car, and then you can drive.
Like, I don't know. From my limited knowledge of what goes on in China is that if that's not good for the people, it's going to be problematic.
And I think that's the point. Limited knowledge. I mean, no one really understands what the hell's going on unless you're in there. And if you're in there, you probably can't freely report it anyway. So
I think the people will be looked after. That's the bottom line.
Yeah. Yeah.
That's my take on it all.
He's got to keep himself in power like every other politician. He's just the same. All right.
We're
Director's
running
cuts. Woohoo.
We're running well and truly
Are we?
out of time. Yeah. Do you want to quickly touch on a couple of?
So I'll take this one, Apple and Tesla. So this is just something that's fascinating. So this chart here looks at Apple's buybacks versus Tesla's R&D and CapEx.
Wow.
How crazy is that, right? So Apple's share buyback to date is more than 14 times the total investment Tesla has made in CapEx and R&D since its IPO, which was December 2010. For context, that's since 2012, $507 billion Apple has spent on buybacks. And since 2010, Tesla has spent about $35 billion on
R&D.
on the cars. So, Apple, if you wanted to get into the EV game, you could have done it friggin' 14 times over the last 10 years. I mean, geez, come on, man. Come on, Tim, what are you doing?
I've got Netflix. So Netflix obviously reported they lost, I think, about 1 million customers in the first half of 2022, like $970,000. Wall Street was expecting it to be 2 million. And so it was better than expected. And so share price jumps. And then obviously we've got the partnership with Microsoft. I don't know about the whole ad-supported model, because Netflix was always, their ethos and their whole business model was based on the fact that there's none of that stuff.
Yep.
But I can't remember whatever the CEO's name is.
Reese Hastings.
Hastings, yeah. He was
Reed
saying,
Hastings.
Reed, yeah, saying
Reed.
that we've realised that it's not all cut out to be what we thought it was going to be, so we're going to have to go down this ad-supported model. But can you imagine like watching a movie and then just boom, this ad pops up like partway through.
Yeah, it's
partway
like
through
friggin' YouTube.
Partway through the movie. I don't know, like I don't subscribe to free Spotify, for example. I reckon the ads would just shit me and you'd subscribe.
It's interesting. Apple TV do it at the start of the show. They'll advertise another show, so it's not an ad. Yeah, you can skip it.
What's the point?
I don't know.
Unless they have it like YouTube, you can't skip it if it's a video that's had millions of views. But if it's a trending video that hasn't had the number of hits yet, you can skip it after 5.
Is that how they do it?
4.
Okay.
3. Yeah. So if it's a video or I think it might be based also on what the advertiser pays. So you can do it so you can't skip, or you can do it so you can skip after 5 seconds.
Is that why you can't skip on ours? Because
can't skip
millions of views and
no, we pay YouTube the marketing fees. The key is just make your ads really short and punchy and sharp.
Yeah.
There you go, marketers. There's
before
a
you get a chance to skip.
Before the ad's done. So Netflix expects increase of 1 million subscribers this quarter.
An increase?
Yeah, an
Okay.
increase. New
Wow.
subscribers are expected
I
to
missed
increase by
that.
1 million this quarter. So there's a lot going on there. Anything else you want to add on?
Oh, on that one? No, did you want to look at that chart? I just thought it was interesting, just the timing of those.
Oh, yeah. We'll get this chart up as well. Netflix subscribers 2015 to 2022. Do you know what? When I saw this and just reading the points of view on Netflix and subscribership and so forth, it just really shows how difficult and how constantly on the move you are for the next big shiny thing.
Absolutely.
And so I think this chart, The Crown season 1, Stranger Things season 3, then you got Squid Game, Stranger Things season 4. Like you constantly need to be bringing out that next thing. And I think I mentioned to you a little while ago, the data was showing that Netflix has like 2 weeks to make this thing a hit or it's done. But you're spending so much time trying to get this new show or movie out and market and released and make an absolute blockbuster. But you've only got a couple of weeks to just make it work.
If it doesn't work, then it's
move on to
a waste of
move on
money,
to the
right?
next thing.
And I guess that's what their rich data is telling them, and that's why they're able to produce movies for certain cohorts. The only other thing I had was just CBD office occupancy percentage of pre-COVID rate. This I thought was pretty interesting, just looking at the trends. So we're back to, and we being Melbourne, this is as of June, back to 49% of pre-COVID rate. Only 49. I would have.
Oh, so this is percentage of pre-COVID-19 rate.
Yeah.
Wow, we're less than half.
I would have bet good money at the start of this year by June, July, we'd be 70, 75%.
That feels about right now that you tell me that number.
50%?
Yeah. So in June at 50%. So if we're in CBD, that probably feels about
Looking
right.
at- Yeah.
50%.
About half of those offices are filled.
Just less than 50%.
But look at Perth. That's fascinating. The timing of their drop, Adelaide, the size of the drop and the rebound there. Like it fell off a cliff.
Yeah, wow.
When's that? Orange. Is that November to January? Maybe people just on holidays.
Yeah.
And then just bounces right back in
Brisbane,
Feb. Whereas
Perth, Adelaide seem to be far more stable than Melbourne, Canberra and Sydney.
more resilient, yeah.
Canberra, I can see why that's happening.
Yeah.
And then Melbourne, Sydney maybe just on the back,
But Melbourne's
off the back
the
of that.
slowest. And that,
Well, what do you think?
Kind of surprises me.
Well, a lot
Maybe
of
it
business
doesn't.
people that I talk to, business operators and owners, just saying we want to get back into the office, but it's politically like we are not we don't have stable footing for us to approach our employees about it
Okay.
because people just want to
Just want to work
work from home. I was talking to someone the other day. He was saying that he's for a lot of their new guys, so accounting firm, they're young, just out of uni and whatnot. He's running workshops about how to kind of conduct yourself in a meeting.
Oh, really?
Yeah,
Because it's something that they haven't.
Never done before.
Experience.
2 years. Never been in a meeting. Just awkward.
Yeah, right.
When
crazy.
I was saying, I thought that I never would have thought that you'd have to run a workshop about how to run a meeting. But this is what we've come to, right? This is what people are have to do.
Yeah.
And they can't get they don't feel they're in a position, and a lot of people are feeling this, to talk to their employees to get them back to the office. They want to come back.
People want to come
No,
back, or the employers want them to come back. Yeah, that doesn't surprise me. And we've said before.
Do you think we're getting like lazy?
Yeah, absolutely we are.
Yeah.
I mean, we get. Yeah.
Let's move on.
Tons of-
We can
You
talk
go
about
first.
that for tips and recommendations.
Yeah, because I just realised I haven't thought about it.
Oh, you didn't get your tip for this week.
Mate, I had 3 or 4 lined up before we had a break, and I forgot to write them down.
Yeah, well,
So fire
so
away,
we went up to Daintree and stayed off the grid in an eco resort up in the rainforest, far north Queensland, and it was a lot of fun. It was relaxing. The only thing I didn't prepare for was the fact that you don't really have that much food supplies around, and you can only eat 2-minute noodles, and for a certain period of time.
You didn't go hunting
No,
for berries, or
we didn't go hunting for berries or leaves or grass. Drinking water from the waterfalls, but we stayed in the beach house up in the Daintree. So it's the very last accommodation you can book before you get into basically 4-wheel drive territory.
Oh, okay.
And there's like nothing.
Yep.
Although I did take our little Toyota and my father-in-law in his Hyundai i30 along the 4-wheel drives.
How far did you get?
We got pretty far.
Yeah.
But Deb was saying, she's like, I don't know how Dad's going to feel about this following you. So we ended up doing a U-turn. The only cars that are passing us and coming the other way just 4-wheel drive, just red.
And they're like,
just
the hell are
done.
these guys doing?
What are these guys
These
doing?
idiots.
In their i30s.
Yeah.
But it was just like literally there was nothing. We just had a cabin, bed, and it was really challenging your resourcefulness, if I can put it that way. But it was just really lovely. Just there's no phone reception. The weather is just absolute, and staying in the rainforest absolutely stunning. Just it's a whole different energy. I don't know how you would feel doing that or taking the kids, but it's and there's just so much so many natural attractions to see. Stuff's not cheap, obviously, but man, it was packed.
Yeah, right. Okay.
You've got these tour buses constantly doing, up and back, safari tours and rainforest tours and, waterfall tours and whatnot. And these guys picking people up, taking them, they're just all day trips and whatnot. And these buses are offloading these people at, the local organic ice cream maker, the place that grows coffee beans and roasts their own coffee, or the cafe or whatever.
Yep.
But the ironic thing I found was when the tour takes you to like crocodile viewing, like in the salt water or in the fresh water, like you see the crocs, and they're so sort of in love with these animals, like these
Tour
guides.
it's their business,
and
right?
they know all the crocs. That's whatever. And then these tours take you to a place where you have, let's go have crocodile burger at this place that does crocodile burgers. And I'm like,
This is Jim. He didn't make it. Poor croc.
I'm like, what the fuck is going on? Like, how can you be so like emotionally connected to these animals or whatever they're called, and then in one breath, and then at the same time, then take the group and go have crocodile burger down the local burger joint. Anyway, if you have been up to the Daintree, it's an absolutely spectacular place to go and see and stay if you want to eat Doritos and salsa dip for dinner. There's not much else up there. What do you got for us?
So I've got a number of things, but I'll go with... so we had a team building day a couple of weeks ago.
Oh, yeah.
I did my first escape room, which I have never done one before. Man, it was so much fun. So we're at Crown, Red Herring Escape Rooms, I think it was. So, kind of, I did not know what to expect. I kind of half wondered whether you're just in there till you literally can work out how the hell to get out. That was sort of my expectation and maybe my hope a little bit. Anyway, so we had this... So for those who haven't been in one, you get this kind of scenario and the people there get in character. So so the lady comes out and goes, "Oh, you the group for whatever?" And it's like, yeah. She goes, "Oh, I'll just be back." And then she comes back in this lab coat and glasses and she's like, "Are you the scientist?" I'm like, "No." You just, in my head, I'm like, no, you just spoke. I'm like, oh, no, this is all part of it. It started. I had no idea what to expect. So funny. Anyway, so we go in and they give you a scenario and it's pretty interactive. I didn't expect it to be as interactive as what it was. So you've got, a video comes up on the screen and you've got the phone ringing and you've really got to kind of apply all your skills, So it was a lot of fun. The room kind of progresses you. So if you're falling behind and you have to, I think one of them was we had to work out how to get the emergency glass down so we could press a button. We didn't quite, that was right at the start, we didn't quite work it out. So it dropped and you press the button. So it kind of helps you move along. But we got out of our own accord with about 8 minutes to go, I think it was.
You said 4.5 minutes.
Okay, sorry, 4.5. Jeez.
Trying to make
Rob wasn't in it with us.
I locked you guys in there. Yeah. Trying to make yourself feel smarter than...
But it was so much fun. It's a feast for the senses. Sight, sounds, kind of you have to really think, work as a team. A lot of fun. So if you haven't done it before, absolutely do one before. It's team building, family, friends, whatever. But absolutely have a go at it. So much fun.
I definitely will take the boys. They'll love. But I got to.
So there are different levels, right?
Yeah, we'll do like a really
basic one, or
beginner
entry or whatever.
Level,
yeah.
And just one with less sort of surprising sounds. Coming out of you.
Yeah. There were a couple where it was like a big sound. I'm like, what the hell was that? And you go through different rooms in this particular one, and so you kind of get into the next room and the next room. But I was saying to Laura, we should take the kids. It was,
your kids are old enough.
Emma's 8. Yeah, the boys are 13. So it was a lot of fun. So definitely recommend it if you get a chance or have the opportunity. Give it a shot.
All right, we've gone
smash through.
Lots to cover today. We'll be back next week. Jump on YouTube, jump on Spotify, hit us up on social media. Tell a friend. Give us
in case they're interested.
Give us a 5-star rating and we'll catch you next week.
Cheers, guys.
Thanks, guys.
Bye.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.